everyone, and thank you so much for joining us for Management Accounting Week. My name's Shana, and today I'm joined by Jeff from Premier Training, who's going to be taking us through variance analysis and flexing a budget. Hi, Jeff.
Hi, Shana.
Thank you so much for joining us today.
My
Can
pleasure.
you tell us a little bit about yourself and about Premier Training?
Okay, Premier Training. I've been with Premier Training for about 20 years. We are multi-award winning. We've won the AAT's Distance Learning Provider of the Year award twice now. We deliver our training through a very innovative online program called the Premier Program. Where we differ from traditional distance learning is that we don't have the paper in an envelope and wait 3 weeks for it to come back routine. With us, your assignments are all presented online. You click the button, send them in. They're in your tutor's inbox, which might be me, might be a colleague. And we like to think we can turn them around within a day or two. The oldest one in my inbox at the moment came in at lunchtime today. So we offer a bit quicker turnaround so you can keep your enthusiasm, you can keep learning. We've lots of videos on our program, and we just try to make it a bit more interesting, a little bit more than just books and paper, the old-fashioned way.
Okay, fantastic. Well, you're in good hands again, everyone. Just a couple of reminders. Please type the word support into the comments if you'd like us to send you the slides from the tutorial. And also that way you can sign up to any future study support videos that we have on Facebook. So any questions, do the normal thing, type your questions in the comments and we'll try our best to answer those at the end. Okay, over to you, Jeff.
Thank you, Shanna. Well, good evening, everyone. Tonight we're going to be looking at a fairly commonplace task that we get given to do. We're going to look at how we go about flexing a budget and then subsequently calculating the variances. We'll start right from the beginning. My name's Jeff Grimston, which possibly you've got already, and I'm with Premier Training. So, very important in management accounting. It's all well and good that we make a plan. What's vital is that we check that things are going as per the plan. One thing to mention, during tonight's exercise, we'll be using marginal costing as opposed to absorption costing. What that does mean is that under marginal costing, we write off all our fixed overheads during the period that they're incurred. None of it's carried forward. So that does mean we won't be looking at fixed overhead volume variances. We'll be looking at revenue variances. We'll be looking at direct cost, material and labour variances. And we will be looking at different types of overhead expenditure variances, which we'll come to in time. So, there's one step that a lot of people miss when asked to flex a budget. We're given the budget, we're given what actually happened. There is a little halfway house that has to be done in between before we go to the final answers. And hopefully, once you learn this step, this will help you do, well, let's say we can make what's normally a tricky subject a bit easier for you. Let's look at a typical example of a scenario that you might be faced with. Carltex is a manufacturer of sporting goods. It produces a badminton racket called the Smash Right. The budget says we're going to produce 9,000 units. And in fact, in March 2018, it was a particularly busy month, lots of orders, so they worked extra and increased output to 10,500 units. We are told material and labour are variable costs. Machine hire is a stepped cost. That's one of everybody's favourites. Each machine can produce up to 2,000 units a month. The words up to are quite vital. That they are the key to working with step costs. Cleaning is semi-variable with a fixed element of £14,000 a month. All other overheads are fixed. And then you'll be typically given a table of data that looks something like this. There's our budget for the number of units, how much we expect to sell them for, what our direct material costs should be, labour, machine hire, cleaning, fixed overheads. That's a typical example of the sort of data that will be given. So, piece of cake. All you do, we're just going to look at budget and actual, and that's the variance. If only. There's a bit more to it. Let's think about why we can't just compare the material we expected to use with the material we did use. Well, if that were the case, we'd go to the factory manager and we'd say, why did you spend more on labour? Look how much you spent on labour compared to the budget. Our budgeted labour figure, for example, was £108,000. He spent £124,500. Surely that's bad news. In fact, for the amount of output that's been achieved, he's actually produced it at a cheaper cost than normal. So that is why we can't simply compare actual with the budget. The budget should have cost us £6 a unit labour. We've actually spent only £5.90. Apologies, those are material figures. That's the material figure. Okay, here's the bit. Here's where most people go wrong. With an exercise like this, the first thing that you must do is draw up a standard cost card. So, what we do, we look at the data and we can produce a template. Blank sheet, 4 headings, 3 headings, sales revenue, direct material, direct labour. Onto this, we can now enter the figures from the budget and we can work out the building blocks that this budget is built out of. First of all, we'll do the items that are variable, that vary directly with output, because these are the easiest. With 3 items here. Sales revenue, £351,000 in the budget for 9,000 units. Give you a second to work that out if you like. £39 a unit. Direct material, £54,000 for 9,000 units, £6 a unit. And direct labour, 108 over 9, £12 a unit. Let's fill them in. Now, machine hire is going to be a bit trickier. It's a stepped cost. The first thing we need to do is work out how many machines are in that budget. We're told that each machine can produce up to 2,000 badminton rackets. So, how many machines do we need to produce 9,000 rackets? Answers on a postcard, no, never mind. 9,000 divided by 2,000 comes to 4.5. Now, each machine can produce up to. That means 4 machines can produce 8,000 rackets. So we need a 5th machine. The key rule with stepped costs, you always round up. And I imagine possibly 1 or 2 people have done this exercise, got that wrong. Now that we know that there are 5 machines in the original budget, we can now work out how much it costs us to hire 1 machine. Our cost is £7,500. 5 machines, so that's £1,500 per machine. Let's put it onto the standard cost card, and there it is. Now, cleaning, you'll see we've got 2 lines. The easy way to deal with the semi-variable cost in this context is simply to split the 2 halves and show them separately. We're told that the fixed element is £14,000. If we take £14,000 from the total budgeted cost of £20,300, that leaves us £6,300 as the variable element. And remember, that was to make 9,000 units, which means that's 70 pence a unit. So, variable cost, 70 pence a unit, and with a £14,000 fixed cost. And we're told that other fixed overheads amount to £18,000. Don't ask me why. Lots of people at this stage are overcome with the desperate urge to flex that. Well, you don't. The £18,000 fixed cost will stay fixed. So, now we've got our building block, we've got the cost card, let's use that to scale up the figures to the costs and revenues that we would expect for an output of 10,500 units. So, sales revenue, we would expect 10,500 units to generate £409,500 worth of sales. In it goes. Direct material should cost us 10.5 times 6, 63,000. In it goes. Direct labour, 10,500 by 12, should cost 126,000. In it goes. Now, machine hire. We're going to make 10,500 units. Each machine can produce up to, I keep stressing those words, up to 2,000 units. 10,500 divided by 2,000, 5.25. That means you need 6 machines. Very popular error here is say 5.25, well that's more or less 5, isn't it? 5 machines can only produce 10,000 units. We have to have 6, even though it means one will be standing idle for some of the time. Always round up with stepped costs. 6 times 1,500 will cost us £9,000. And the popular errors are to either round down. A lot of people also with stepped costs treat it as a variable cost. Just divide the original cost by the original number of units and scale it up. That won't work either. So, machine hire, our expectation for 10,500 units is £9,000. Now, cleaning with 2 elements. The variable cost, we would expect 10,500 times 70 pence, 7,350. The fixed element is 14,000. And I said it a couple of minutes ago, the fixed element is fixed. So 73.50 variable, cleaning cost stays at 14, and likewise fixed overheads are fixed. I keep saying that because I've seen lots of cases where we just get this urge to flex the fixed costs. You don't flex them, they stay as they are, or they should. And in it goes. So now, what we've got an analysis of exactly how our cost is made up. We now have, in the right-hand column, our flexed budget, which is completely different from the figures in the original budget. We now have something that is useful that we can use to compare with what really happened. So, another template to draw up now. We're going to transfer that flexed budget into a template. We don't need all the workings necessarily now. We're going to have 4 headings: flexed budget, actual, variance, and whether it's good news or bad news. Let's put our items down the side, and notice now we're going to compare the operating profit under the revised budget with the operating profit under the flexed budget and the actual. So, in goes the flexed budget, the figures from the previous template, and this time we can work out what our expectation of profit is, which is 172,150. That's just the revenue minus all of those costs. Now, let's look at variances. Here's the actual data, which I've simply copied straight in from the data that was given at the start. So, our sales revenue, we've actually achieved a revenue of 404,250. Oh, I missed a step. Actual operating profit, 168,800. So now, sales revenue, we expected to achieve 409,500. We actually achieved 404,250. Before we do any calculations, take a step back from the figures at this stage, say to yourself, is this good news or bad news? Well, what we've achieved is less than we expected. Sales revenue, that's bad news. The amount is 5250, and that's an adverse variance. There's always a temptation with a table of figures to start thinking, if left's bigger than right, if right's bigger than left. You can't do it that way. Just look at each one, think about what it means, put yourself in the real world. My sales revenue is less than I expected. That's bad news. In it goes. Now we'll look at material. You'll recall that we've used a lot more material than was in the original budget. However, on the flex budget, we would now expect to spend £63,000. We've actually spent £62,000. Again, take a step back. Is this good news? Is it bad news? Material cost me money. I've spent less than expected. That's good news. Then work out the figure, £1,000, and it's favourable. Let your common sense be your guide. Don't get into this mechanical routine of tapping in the numbers, reading them off the calculator, and ignoring what they're supposed to mean. Notice a cost variance is the opposite way around to a sales variance. Let's put it in. Next one, labour variance. We expect to spend for this amount of output £126,000. We've spent £124,500. Good news or bad news? We've saved money. That's good news. That's £1,500. Let's put it in. Machine hire. Expected £9,000. Sure enough, we hired the machines that we thought. It's cost us exactly what we thought it would. No variance. Don't ever be afraid if you're working out figures, if you actually get no variance, it can happen. Don't assume because you've got a table with boxes in it that every box must have a number in it. Again, let your common sense be your guide. If something costs what you expected, then it's no variance. Cleaning cost, we've rolled these up into a total. We expected to spend £21,350. We've actually spent £21,450. Our cleaning has cost us £100 more than expected. That's bad news. Fixed overheads. Lots of people would get this wrong in a training exercise because they would have flexed that 18,000 just because it's a number and just because we're changing everything else. In fact, the 18,000 fixed overheads has stayed the same as the original budget, so our actual cost of 18,500 is bad news. We've spent more than expected. It's bad news, adverse variance. Let's put it in. Now, we've almost completed the exercise, but there is one final step that's worth taking. Let's just look at our profit variance. On this volume of output, our expectation is we generate a profit of 172,150. In fact, we've generated 168,800. Step back, when all those costs were less, that was good news. Profit less than expected, well, it's got to be bad news. Adverse variance. Now, there's one last check that we should do. If we've followed the rules and all of our calculations are correct, we should find that when we sum up those individual variances, they should exactly be the same as the difference in the profit. It's not guaranteed, but if you get the same figure for both, you can move on to your next task, whatever it is you're going to do, with a reasonable amount of confidence that you've got it right. Let's have a look. Sales variance 5250. This time I'm showing just positive and negative for simplicity. Adverse ones I'm showing as positive figures. Material, take that off, subtract the labour, they were both favourable. Cleaning was more than it should have been. Fixed overhead was more than it should have been. Roll them up, they come to 3350. Our net profit variance, which we just worked out, was indeed 3350. That's what I call a result. And that, in a nutshell, is how you flex a budget and analyse the variances. It remains now for me to say, does anybody have any questions?
Okay, thanks so much for that, Jeff. So we've had a couple of questions. Oh no, just one from Dominica. I think they've answered it, someone else in the video, in the audience. But she's asked why 18,500?
There isn't a reason. That was an actual figure. So if you like, the why is because that's what it cost us. The actual data is what really happened. Maybe that would come about because we had to do a bit of extra maintenance because we produced more than expected. There could be any number of reasons why the fixed overhead cost was more than it should have been, but with actual figures, that's what really happened.
Okay, fantastic. Yeah, and Tim, thanks a lot for helping us answer that question as well in the comments. And that's all we've had for questions. So thank you so much for that, Jeff.
Well, thank you for listening, everybody.
So we've still got a couple more days left of Management Accounting Week, so please take advantage of all the extra resources available. Again, type support in the comments if you want the slides sent to you, and we'll see you soon. Thank you.